A quick disclaimer, this video is for education purposes only. Forex involves a high risk reward and a high risk business, and you should not trade with money that you cannot afford to lose. This channel serves as an education purposes and not as an advice to buy or trade in Forex instrument. See the description below in this video for full disclaimer. Hi, welcome to FX Newpip, and this will be our 6th lesson in beginner course. In this lesson 6, I will talk about what is bid, ask price, spread, and types of spreads, factors that will influence your spreads, and also is spread important in our trading. So let's get started. The term bid and ask price in Forex is referring to the currency price in Forex trading. The price that we pay to buy a pair is called ask, and the price we intend to sell is called bid. The ask price is always slightly above the market price, and the bid price is always slightly below than the market price. Forex pairs come in pairs, and if you see Forex pair, there will be price on the left known as the bid, and the price on the right is called ask. Like in stock market, when we successfully purchase a stock, you will be charged on the handling fees through a percentage. That is the commission stockbroker earn, and the same goes in Forex trading. The difference between bid and ask price is called spread. Spread is a commission that Forex broker earn from trader when they place a trade. It's pretty straightforward to know the spread. Take the ask price minus the bid price and that answer, which is equivalent to spread. If you look at the figure, 1.2068 minus 1.2070 is equivalent to 0.0002 or 2 pips. For example, if 1 pip is equivalent to $10, when you place a trade, immediately you will have a negative 2 pips or equivalent to $20. This $20 is the commission your Forex broker earn. So by now you will understand what is bid and ask, what is spread, and how your Forex broker earn their commission. In this slide, I will illustrate how the bid and ask price looks in real chart. Figure on the left is MT5 chart. Before I dive in further into it, MT5 platform is a standard international Forex trading platform. Some broker will have their own, but MT5 is a standard one, and we will also have MT4, which is the first version. Figure on the right is where I zoom in how does it look for bid and ask price in real chart. Please take a note that this is a 4 decimal values, and I use 4 decimal values for an easy understanding and calculation. In case you need to refresh what is 4 decimal values, you may watch our lesson 3, what is pips. As you can see, this is Euro USD pair, and the sell price is 1.1101, which is the bid price, and the ask price is 1.1103. So we will take ask price 1.1103 minus the bid price 1.1101. The difference is 0.0002 or equivalent to 2 pips. Another things that you will need to keep in mind is major currency pair like Euro USD, USD JPY, or GBP USD normally have a small spread size ranging from 2 to 3 pips, and exotic pairs will have a bigger spread size from 7 to 8 pips. Different Forex broker also offers different types of spread size to attract traders to open a trading account with them. So you might be wondering why Forex broker are doing that. I will cover that on the later part in this lesson. This is another example with different pairs. This is USD JPY pairs. If you notice the difference, USD JPY pairs requires 3 pips commission to broker. By now you would have understand what and how bid and ask price works, and the difference between bid and ask price is called spread. Now I will talk about spread. There are 2 types of spread in Forex trading. Figure on the left is called fixed spread, and figure on the right is called variable spread. The difference is pretty straightforward. Fixed spread is where the spread you pay is fixed, or in another term is the commission you pay to the broker is fixed. Variable spread is the ask price versus the bid price always fluctuate, so it depends on trader style. Some traders I knew, they only use fixed spread due to the volatility in the market, but that doesn't mean variable spread is not good as well. I will explain in details the difference between these two, and I hope it may help you in your trading style whether to use fixed spread or variable spread. I have drawn a variable spread in picture. As you can see in Forex market, we have a few different time for trading. What do I mean by that is in forex trading we can have active hours when this is the best time to trade. We have news hours, we have non-active hours where market is ready to close and change session, and we have big news trading hours where big news like non-farm payrolls, bank interest rate decision. As you can see, spread size in active trading is considered relatively stable, which means the commission you need to pay to the broker might be even lower than the fixed spread. This also doesn't mean that the fixed spread is only 2 to 3 pips all the time. Why I say so is because even if fixed spread under a high volatility scenario, it can go as high as 5 to 8 pips for major pair. If you notice there is an event like sudden news, and what do I mean by sudden news is like, for example, US President suddenly tweet that they want to impose a high tax rate on China import, and in return China will retaliate on this. This can cause a massive spike in forex market. No trader has a control over such news because it can happen anytime. That is why stop loss is very important and money management risk. NFP, also known as non-farm payroll, which is the key economy indicator for US economy, and it represents the number of jobs added. This is one of the big news in forex market, which will be released every first Friday of the month. And I highly don't encourage new trader to trade such news without a proper understanding about forex fundamental and knowledge. I myself don't trade NFP. I will only trade after the news, after see how the price action works and the outcome from the news. In forex trading, we can't predict the market. What we need to do is to follow the market trend. This is another example how it looks like for a normal spread versus spread under high volatility condition. Figure on the left is a normal spread. Normally non-active trading hours and active trading hours it only consume 2 or 3 pips for major pairs and up to 8 pips for exotic pairs. On the right is an example under high volatility conditions, which can cause the spread to go as high as 20 pips. Here are the summary of advantage and disadvantage between fixed spread versus variable spread. Under fixed spread, the advantage is you doesn't need to worry about the unexpected variables, and it is a great start for new forex beginner traders because you will roughly know before you place a trade how much pips you need to allocate to broker as their commission. The disadvantage is some brokers restrict trading during big news or events. So far, I never experienced brokers that don't allow you to trade during big news. The big news I'm referring here is not NFP, but more like a presidential election kind of news. So now in forex trading, there are few types of trading strategy, and I will cover that in the future lessons. What do I mean here is, if you plan to become a scalper, then fixed spread is not suitable for you. Scalper means you will enter and exit from your position within few minutes of time. By doing so, you will lose more on the commission because it is fixed. On the variable spread, like I mentioned earlier on, the bid and ask price always change according to volatility and liquidity. The advantage for variable spread is that trader doesn't need to worry about requotes, and of course in the competitive market nowadays, most forex brokers offers a good spread to trader. The disadvantage is sudden news or big event that can impact significantly on your spread, and it can trigger protective stops and limits. To recap, there are main 4 factors that will influence spread. 1. Volatility of the currency. High volatility currency, also known as exotic pairs, have higher spread to the risk. Example, GBP, AU, Australian dollar, and so on. As a beginner, I would advise you to start trade with only major pairs. Once you have mastered the technical analysis part and consistent with profit, then only you move to exotic pairs. 2. Mostly major pairs or popular pairs have a lower spread like Euro USD, USD JPY, GBP USD, and USD CHF. 3. Level of market activity. This applied to a variable spread. If you choose variable spread and trade during active hours, your spread can be even lower than the fixed spread. 4. Political and economic risk. Here is referring to the news event which you can find out from websites like Forex Factory, Calendar, etc. Normally every Sunday I will look at calendar to see whether is there any big impact news for that week before I plan my trade. Here you can see different forex brokers offers a different types of spread. You may also click on the link I provided in the description below in this video to check the spread offered by brokers. Last but not least, is spread really important to our trading? Yes, if you open a Forex trading account with an unscrupulous Forex broker, your spread can be manipulated and your account can easily fall into margin call. With spread, trader can actually plan their trade. For example, if the reward to ratio is 1 to 1, meaning to say if I open a trade with a stop loss of 30 pips, then I need to set my profit at 32 pips because the extra 2 pips will be the commission to the Forex broker. So that's it for today. I will see you again next week. Thank you. If my Forex education channel helps you in your Forex trading journey, please remember to click subscribe and also select the bell icon to get notified every time I post a new education video. Please share this channel to your friend if you find it useful, and let's together we impact a million lives.